a measure like something called open interest for both Ethereum and Bitcoin are at record lows at a time when the technicals for both Bitcoin and Ethereum are flipping positive. So I think you're going to see a crypto rally into the end of the year. And it really does help to see JP Morgan say they're open to the idea of using crypto as collateral.
You've seen the Fed's standing repo facility, which is an emergency financing tranche, being used quite heavily twice. And you've had Jay Powell, the Fed chair, de facto announce on Tuesday that quantitative tightening was ending. The system needs more liquidity. The bottom line is that simply ending QT is not enough. They're going to have to do a lot more than that.
Market shifts are never random. They're driven by the deeper forces of liquidity, policy, and sentiment. Right now, top macro strategists Tom Lee of Fundstrat and Michael Howell of Cross-Border Capital both see those forces aligning again. Lee, a consistent Wall Street bull, believes Bitcoin and crypto are on the verge of a new upcycle. With leverage flushed out, technicals turning positive, and institutional adoption rising, he sees the stage set for a strong crypto rally into year-end, especially as the Federal Reserve pauses rate hikes and leans toward more liquidity support. Michael Howell's analysis adds weight to that view. As a leading authority on global liquidity, he notes that financial systems are under stress, repo markets tightening, and central banks quietly backing off quantitative tightening. His conclusion is clear. The next move will be injecting liquidity back into market. When that happens, history shows where the money flows first, into Bitcoin, Ethereum, and risk assets across the board. Together, Lee and Howell's outlook suggests we're standing at the edge of another powerful liquidity-driven cycle, one that could redefine the market's momentum heading into the next year.
Hey, I am Maria with DailyDoseCrypto. Have you noticed that gold, silver, and Bitcoin have hit all-time highs recently? Is this a coincidence, or are smart investors onto something? The dollar is depreciating, inflation is eating up all of our cash, and the US national debt is through the roof, hitting new highs every day. That's why people are shifting to alternative assets like gold, silver, and Bitcoin. We at DailyDoseCrypto have partnered with ITrust Capital, your one-stop platform to buy and securely store 80+ digital assets, including Bitcoin, gold, and silver to hedge your future against debasement. With over 200,000 accounts, 15 billion in transactions, and 11,000 plus positive reviews, they're helping real investors build long-term wealth with their tax advantage, IRA, and PCA, which is a premium custody account that supports the highest level of custody and security in the space. They do this all with institutional-grade custody through partners like Fidelity Digital, Fireblocks, and Coinbase Prime, keeping your assets secure while you can trade 24/7. Fees are just 1% per transactions with no monthly or annual costs. Getting started is simple. Sign up for free and fund an IRA or PCA today. You'll receive a $100 bonus and start growing your assets the smart way. Click the link below to open your account now and begin your journey toward generational wealth.
So why should investors be more bullish on risk assets, the market overall, than they were 6 months ago?
Well, John, even at the April lows, just to be clear, our S&P year-end target was 6,600. So we were still expecting explosive recovery in markets. But we are above that level. And, we're 10 weeks before the end of the year and the S&P is at 6,800. I think it's still a base case then for people to say that in just a typical year, the S&P should gain another 4%. That would put us over 7,000 into the end of the year. And I think that that's sort of the minimum. But because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P, given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
Wow. Okay, so where does crypto fit in, especially when you're looking at how those currencies are moving versus what's happening with tariff concerns, global trade concerns, et cetera?
Crypto had a huge deleveraging event on October 10th, and part of that was triggered by the escalating tensions with U.S. and China on tariffs and trade. And that was the biggest liquidation event in 5 years for crypto. So there is still those ripple effects, 2 weeks later that are plaguing the crypto market. But I think we're almost through that because a measure like something called open interest for both Ethereum and Bitcoin are at record lows at a time when the technicals for both Bitcoin and Ethereum are flipping positive. So I think you're going to see a crypto rally into the end of the year. And it really does help to see JP Morgan say they're open to the idea of using crypto as collateral. I mean, I think it's sending a pretty bullish signal. Part of it is it's a counterfactual statement, but crypto had the biggest liquidation event, deleveraging event in history. You know, I mean, the number is probably multiples of what happened during FTX, and Bitcoin ends up down 3 or 4%. So I think it shows you that Bitcoin itself is proving to be a pretty good store of value, because if we had seen this happen with gold in the gold market, if there was a huge deleveraging event and gold was only down a few percentage points, we'd of course consider that a real validation. And it's also true of Ethereum, because Ethereum is seeing so much activity growth. I mean, on the L1 and the L2, because of stable coins, and it's not reflected in the price. It does take time. So to me, because like what I'd call the fundamental activity on Ethereum is really picking up, it argues for a pretty big move into end of the year as well.
Michael Howell explains that global liquidity is nearing a major turning point. After years of tightening, central banks are running out of room and will soon need to ease conditions again. His data shows commodities rising, credit tightening, and markets leaning heavily on central bank support, clear signs of a shift. He believes this liquidity cycle, which repeats every few years, is about to reverse. When it does, new capital will flood into markets, sparking rallies in equities, bonds, and especially crypto, potentially kicking off the next major bull phase.
Well, I think the thing to start with is, where we are in the liquidity cycle. And, we've been warning for, few months now that we're getting near the peak. I mean, we haven't really been going risk off, but we've been saying that we're getting closer to that peak, and that peak could be, a watershed clearly for risk asset markets. It was great on the way up as liquidity was going into markets, and it may be a pretty difficult ride on the way down if that roller coaster starts to dip and start to go back towards a trough. And that is really the danger we've got to try and spot. We've been arguing that if you look at the liquidity cycle, it was anyway slated to peak sometime later this year, probably early or possibly early 2026. A lot of people are suggesting it's different this time. It's always dangerous to say that. So I think we've got to be alert to the normal tempo and normal frequency of the cycle. And that says that we're in the grey area now, where the cycle could end fairly quickly or fairly soon. And we've got to be alert to that, any tensions in markets that we're seeing. And I think what we're beginning to spot are signs that we may be getting an inflection. Now, the key question is how the policymakers react to that. It's not over until it's over, of course, and policymakers may react positively. But I think the problem is they're sort of grappling around now, trying to find exactly where they are. They're not too sure themselves. And there's a growing reluctance, particularly among key US policymakers. I'm thinking here of Scott Bessent, Treasury Secretary, Stephen Miran, the new appointee of the FOMC, and actually Jay Powell himself, chair of the Fed, to say that they don't really want to be expanding the Federal Reserve balance sheet anymore. Again, I mean, they don't want to do a QE because they reckon it's ill-directed or can be misdirected. It basically inflates asset markets over the real economy, and it really has been behind these great wealth inequalities that we begin to see, opening up in Western societies. So the argument is they want the real economy to benefit now, not Wall Street. And that is really a tension that we've got to try and work our way through. So if you look at the data, and I'm going to switch to a presentation now. Okay, so what we have here is the global liquidity cycle. And this is the cycle of money flow that is going through world financial markets. It measures money in financial markets, not money in the real economy. It is not a money supply measure per se. It really looks at, if you like, the balance sheet capacity of credit providers worldwide. So it's really the capacity of the system to lend. And what this is showing is this flow of money, and you can see that it's cyclical. This chart reflects the growth rate or the underlying momentum of liquidity flow. We've got the data here going back to the mid-1960s. It has been, we've been monitoring this, continuously for the last 30 years. So a lot of this data has been put forward in real time. And the dotted red line is a sine wave that we imposed on that or calculated and overlaid on that data about 25 years ago, in fact, in year 2000. It was derived by a Fourier analysis of cycles. It's a sine wave, and it's just been extrapolated thereafter. So what you see is what you get. It hasn't been force-fitted, if you like. And basically, that cycle is moving in a 5 to 6 year wave. That wave is a refinancing, a debt refinancing wave. So the average duration of the liquidity cycle of 5 to 6 years or 65 months happens to correspond almost exactly to the average length of debt or maturity of debt in the world economy. So hence it's a refinancing, a debt refinancing cycle. And it reached its low point in October of 2022 and has been rising pretty consistently thereafter, with a couple of little wobbles maybe, but we're heading towards a peak. And it may be that peak is coming now, because if you look at the latest inflection downwards, which occurred last month in September, that was really forced by the Federal Reserve, and the Federal Reserve, which seems to be taking quite a lot of liquidity out of markets. And that clearly is a worry. We've got to be alert to that. Now, the risks in the system are that if you don't have liquidity, you get a financial crisis. And I'm going to show that mechanism, and I'm going to come on to deal with what the Federal Reserve is really doing, or maybe is actually doing, and maybe what it doesn't intend to do. In other words, this could be an accident. But let's work through the mechanics of the repo market and what's going on. So if you look at the length of a cycle, you can see, according to this chart, that the average cycle is that broken black line. This ranges from 1970 to 2025. And the red line is the current cycle. So although we haven't yet started to inflect downwards, it does show that we're somewhere near the peak of a liquidity cycle. And this is clearly something we have to be very alert to. Now, what does this mean? If you look at asset allocation, this diagram shows the schematic cycle. And on the left-hand side, we look at different phases of the liquidity cycle, which we generically call calm, speculation, turbulence, rebound. Risk on is an upswing and risk off is a downswing. And then on the right-hand side, you can see what that means for asset allocation in the same phases of the cycle. So equities do really well on the way up through the risk on phase. Cash or defensive assets are what you really want in the risk off downswing. Bonds excel at the trough, that's long duration government bonds, and commodity markets do really well at the peak. And commodities are racing ahead now. Looking at world markets, commodity prices are clearly lifting significantly. And that is really evidence of the fact that we're somewhat near the peak of the liquidity cycle. So everything kind of lines up, and that's what we intend to do when we study markets. We look for consistency and to try and pinpoint where we are in the cycle. And this suggests to us that the peak is close. Now, what are the problems if you get near a peak, and what are the risks of a market sell-off? For that, we need to go to this schematic diagram, which is describing the world financial system. Now, what this diagram principally says is that at the heart of global financial markets is a debt liquidity nexus. Now, this is not the typical understanding of textbook finance, because they tend to ignore this model. Their view is that capital markets are all about raising new capital for investment projects. Unfortunately, that's a very archaic or out-of-date view. Financial markets today are all about refinancing debt. And if you look at the right-hand side text, it says something like 70 to 80% of all transactions in markets, primary transactions, are refinancing or debt refinancing transactions on our estimates. So at the heart of the system is this liquidity debt nexus. The paradox is that debt needs liquidity for refinancing, and liquidity needs debt or good quality debt for collateral backing. And on the left-hand side, you see the collateral markets, the repo collateral markets, and something like 77%, very precise figure, but that comes from the World Bank, of all global lending now is collateral backed. And that's something which has moved up substantially as a proportion since the global financial crisis. Now, in order to monitor the health of the repo and the collateral markets, two things are very important. One is the volatility of collateral, in other words, the volatility of US Treasury bonds, which are mainly used as collateral. So volatility, move index, monitor that. And the other is SOFR spreads, which is the rates in the interest rates in the repo markets, which are really reflecting whether you get a collateral or liquidity imbalance. Now, what we can see on this chart here is the ratio between debt and liquidity. And you'll see the history going back to 1980 annually, which is showing the debt to liquidity ratio. What I've done is annotated on the graph where you get financial crises. I would argue that every financial crisis in the past 50 years has really been a debt refinancing crisis. That occurs when you get high debt liquidity ratios. There's far too much debt for the pool of liquidity to refinance. And when you get that imbalance, you get a refinancing crisis, and the central banks have to come back in. If you look at the lower part of the chart, what it says there is that if you get excessive liquidity, then you get a situation where you get asset bubbles, because asset markets are the vent for excess liquidity.
Michael Howell's final analysis paints a clear picture of a fragile global system dependent on the balance between debt and liquidity. As repo markets show stress and the Fed quietly winds down quantitative tightening, it signals an inevitable return to liquidity injections, whether through stealth quantitative easing or direct market support. This environment, while risky, often sets the stage for major rallies, particularly in assets like Bitcoin that thrive on liquidity expansion and fiat debasement. If Howell's projections align with Tom Lee's technical outlook, crypto could be on the brink of another powerful bull run similar to 2020-2021. The same vulnerabilities threatening the financial system might also become the catalysts for Bitcoin and Ethereum's next leg up in 2025. Do you think the next liquidity wave will push crypto to new highs? And could this cycle mark the start of a long-term shift toward digital assets? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.